With the end of the tax year approaching, it's worth considering the different ways in which pension contributions can help to mitigate income tax. The annual allowance for pensions for this tax year is £50,000. What that means is anyone who has the earnings to back it up can make contributions up to £50,000 and receive tax relief. So how would this work in practice? Well, for a 40% higher rate taxpayer, what would happen would be they would make a contribution of £40,000, they would receive £10,000 at source free tax relief from the government. They could then claim an additional 20% on their self-assessment tax return. So it works out as a very beneficial way to invest into a pension and save tax. For the lower end of the scale, if you do not have any earnings, you can still pay into pensions up to £3,600. So you would make a contribution of £2,880, receive £720 from the government. The real benefit to this is you are getting tax relief at 20%, but if you're not a high earner, when you take the money back out again post-retirement, the likelihood is you won't be paying tax. So you've had tax relief that you've effectively never paid the tax for. Now the government is reducing this annual allowance. In previous years it was much higher, this year it's 50, from next year it will be 40. However, you do have the option, if you are a very high earner, to go back and utilise annual allowance from previous years to make large contributions. If you do have any queries, please contact your Courtiers advisor.